Hey, good day, good day, good day, everyone. It's Lifestyle Focus Friday. Today is Lifestyle Focus Friday. Good afternoon, good afternoon, good afternoon. This is When the Lights Go Out. Are you ready? I'm Ronco Johnson, your host. Thank you for joining us. Today, we're going to be talking about part two of loans that are lower than unsecured loans. Three types of loans that you might need to know about that you haven't probably talked about very often. But we're going to dive into how loan interest rates work, the types of loans that are available, and the impact that it has on your income tax. And on the inside, we're going to provide you some examples of how these things work. So sit back, relax, and unwind, and join us on the inside. This is When the Lights Go Out. Are you ready? I'm your host, Ronco Johnson, and I'll see you there. Hey, everybody. Good afternoon. Good afternoon. It's Ronco Johnson. This is When the Lights Go Out. Are you ready? Good afternoon. It's Lifestyle Focus Friday. Joining us for another Lifestyle Focused Friday. How's everybody doing today? How's everybody doing today? Hey, today we got a wonderful part two that we need to talk about. Yes, if you missed part one, we talked about the difference between wealthy and people who make less money, what those loans look like, how we think about our ability to use these things. And today we're going to be talking about part two. We're going to be talking about unsecured loans, three types of unsecured loans that are less to use than unsecured loans. And what does this mean to you? We're talking about cash value. We're talking about HELOCs. We're talking about margin accounts. And we're going to talk about how these loan interests work and the types of loans that are available and how it impacts your income tax, and providing you examples of how you can use them in your everyday life. And you may or may not have been paying it attention. And we want to bring light to it. And this is what millionaires and billionaires do. They've been doing it for a long time. And that's what our scope is, to talk about what is lifestyle-focused wealth. Well, we want to talk about what millionaires and billionaires do. What's up, Sam? I see you out there, right there, bright and early. I see you. Thank you for joining us today. Hey, listen, while you got a chance, I'm going to give you an opportunity to get inside the room, because I'm going to tell you now, we don't want to miss these opportunities. Because I'm giving a whole bunch of nuggets. And this is part two of what we talked about last week. And understanding what loans are, because, I think everybody understands what a loan is. It's just the fact that we don't understand how the wealthy use these loans compared to maybe how you see it, how you're using these things. And we want to shed some light to it. Right? We're all familiar with many different types of loans, right? And I think it goes without saying that when we talk about loans, we're all pretty much, we know about personal loans. We know about mortgage loans, student loans, auto loans, and business loans. We're familiar with all of those things. Would you agree? Hey, happy Friday to you, Miss Henderson. Thank you for joining us. And if you're just clicking in, I'm just going to wait till the room fills up just a little bit to give you some time to get in the room so we can talk about the impact that this has on your financial plan, your loans have on your financial plan, and how we see things, how the wealthy see it, and then how people who make a little less money see it. It's interesting how we could be talking about the exact same thing, but processing it very differently. And I'm here to kind of shed the light on these things for us today, right? I know with me, give you an example. I can't wait to talk about it. I'm trying to hold it back. Because you guys deserve it. So I'm not going to say that. I was going to go into it right away, but I'm not. So first of all, let me just go ahead and say thank you guys for joining us. This is Lifestyle Focused Wealth. It's Lifestyle Focused Friday. This is when the lights go out. Are you ready? And if you're a beginner, if you're the first time coming in, thank you for joining us today. All right? Thank you for joining us today. We can't do it without you. Over the last couple of weeks, we've had some people sending us email, text messages, and all the sorts. And I know you're engaged in the content, and I'm welcoming you to be engaged in the content. So thank you again for coming back to Lifestyle Focused Wealth. And when the lights go out, are you ready? So here's the deal. Why are we calling it when the lights go out, are you ready? Because a lot of people are walking around with their lights out. And our goal is to give you an idea or two that maybe just will turn your lights on. Make you see things a little bit differently, Sometimes we feel like we're all by ourselves and the lights are off. If you can imagine being in this huge auditorium and all the lights were off, and you were sitting in a chair in the middle of this auditorium, something like a convention center in your hometown. Imagine someone turning off all the lights and letting you sit there for an hour. It's quiet. It's dark. You start to hear things that you've never paid attention to. But all you have to do is get out of your chair and find your way out. But remember, this is thousands of feet. It's dark. You've been positioned to sit in the middle. For those of you that are a little bit intimidated by the dark, you're probably a little nervous. Then you hear things running across the floor. Maybe it's a rat. Maybe it's a squirrel. You don't know what it is. Your mind starts thinking about things a whole bunch of different ways. So you venture out. You have to get out of your chair and you venture out and you're trying to get out of this dark place. But every step you take, you hear some noises that make you stop in your tracks. Well, what is the benefit of being part of When the Lights Go Out, Are You Ready? In our Lifestyle Focused Wealth community, imagine the lights coming on. And the room is filled with people that have been around you all your life. And they're lining the outside walls of the auditorium that you were sitting in the middle of. You had no reason to be afraid of the dark because your community had your back. The noise that you heard was the shuffling of your community sitting in the chairs, waiting on you to extend your hand, asking for help. Ladies and gentlemen, that's what this is all about. It's a very holistic way of thinking about our lifestyle focused wealth philosophy. And we want to make sure that we're extending our hand to our brother and to our sister. Because you're in the dark doesn't mean you're alone. All you have to do is reach out for some help. And that's what we're here to provide. If you can relate to what I just said, give me a thumbs up. Give me a thumbs up. Don't forget to like us, share us. I want to encourage you to put takeaways in the comments. And in the takeaways, that allows me to know that you're there, and allows us to be able to find you during the broadcast today and talk to you live while I'm on camera. But if you're catching this in replay, please leave us a comment. We love your comments. And if you would, engage on the website. Go on to our YouTube channel and just engage. And we'll promise we'll respond to you. Okay? So, hey, listen, if you're out there, go ahead and tell your family, friends, share it, like it, subscribe, and don't forget to hit that notification bell, because we want you to get all the information that needs to come to you in a timely manner. This content that we're providing for you is something that we want you to be able to get onto. And at the end of our broadcast today, don't forget to go into our descriptions and look for the opportunity to sign up for our bi-weekly email that we send out. This week we had some great stuff. We got some engaging things, articles about art, travel, recipes, lifestyle stuff, right? Lifestyle stuff. That's what we're looking at. And I know you will enjoy it. But let's dive on into today's topic, if you will. We're talking about loan and interest rates and how those things can affect you, right? Let's talk about it. Before I get into our main topic, and we're just gonna set you up a little bit. I'm gonna tee you up just a little bit, because there's somebody on this broadcast or someone that's going past this that says, "Oh, I already know what you're talking about. Oh, I already know what you're doing and where you're going with this." That's exactly why I'm going to make you wait to the end. You're going to have to wait to the end, Jack, just to get it. All right. So let's talk about these loans. Personal loans, first of all. Personal loans, we all understand what a loan is, right? We do understand what loans are. Let me make sure you understand. Loan interest, loan interest works like this. Loan interest is basically the cost of borrowing money. It's typically expressed with an annual interest rate, right? It's known as an APR. Yes, it's known as an APR. So you guys, you get to see these APR rates and these things going on all the time throughout. Whenever you go to the bank and you buy you ask for your loan, you'll see it on your credit card. You'll see it on your statements. It's when you take out a loan and you agree to repay the principal plus an interest rate over a specified period of time. That interest rate can be one of two things. It can be fixed or it can be variable. It can be either one. It can be one of the two, right? Variable meaning it's fluctuating with the market. Okay. So we want to make sure everybody is on target here. So for example, if you were to borrow $10,000 at an APR of 5% one time a year, you will pay $500 in interest, making your total repayment $10,000, $10,500, excuse me. So you've added an additional $500 to your $10,000 loan, okay? And as I said at the top of the program, most people are familiar with personal loans. Personal loans are unsecured loans that have various personal experiences that can be used for, such as medical bills, home improvements, right? And the interest is generally higher due to the lack of collateral. Because collateral meaning it doesn't have anything to hold it, to exchange for it. So that's why you pay a little bit more. Mortgages is a second type of loan that we are familiar with. Secure loans used to purchase real estate. These is what mortgages are. But the property itself is the collateral, typically resulting in lower interest rates. Why? Because the mortgage itself is the collateral, or the real estate itself is the collateral, right? So mortgage interest rate is often tax deductible. It just depends on where you are. But here's number three. Number three loan, student loans. We're familiar with student loans as well. Thank you for your comments. By the way, I am watching you. Go ahead and make all the comments, and I'll come back to you. And I just want to get through the process here. But the student loans are specifically for education expenses. They often have lower interest rates as well. And they may offer some tax deductibility. But again, there's not a lot holding that. How about auto loans? Auto loans are a secured loan used to purchase vehicles. So the vehicles serve as the collateral. If you don't pay that loan, they're taking your vehicle, right? Which can also lead to lower interest rates compared to unsecured loans. Business loans, number 5. Business loans are loans used to finance your business operations. Expansion of your business. Maybe you need equipment that you need to purchase. The interest on business loans can be tax deductible. The impact of income tax on that business loan is a little bit different. That impact on that mortgage loan is a little bit different. So let's talk about the impact of income tax. Income tax can affect the net cost of borrowing money by allowing deductions on certain types of loans. For example, your mortgage interest deduction. Homeowners can deduct interest paid on mortgages from their primary and secondary residences by reducing their tax deductible income or your taxable income. In other words, if I paid $5,000 in interest and I made $40,000 of income, I get to subtract the one from the two, meaning I didn't make but $35,000. That's how you're reducing your income, by deducting this interest that you're paying on your mortgage. Let me give you a different example. If you paid $10,000 in mortgage interest this year, and you're in a 24% tax bracket, you could reduce your taxable income by $10,000. And that's saving you $2,400 in the tax a year. Some of you might say that's not a big deal, but to me, that's a big deal, right? That's a big deal. You know what we can do with $2,400? Some of you guys can already answer the question for me. Some of you guys can already answer the question. That's a nice vacation. That's what somebody's saying in the chat. That's a nice vacation. See, there you go. You're already spending the money. You're already spending the money, okay? You are correct. It is a good vacation, but that's not what we want to do with it. All right? So let's talk about the implications of you guys are nuts out there. Let's talk about the impact of income tax on the student loan. The student loan interest deductions. You can deduct up to $2,500 a year of interest paid on qualified student loans, right? But it's subject to income limits. So in other words, for example, if you pay $1,500 in student loan interest and qualify for the deduction, you can reduce your taxable income by $1,500. That's pretty good, right? How many of you knew that? Give me a thumbs up out there. Give me a thumbs up right there. Let me know if that's something you already knew about. Let's talk about business loans. In business loans, interest deduction. Interest paid on their business loans used for business purposes can be deducted as a business expense, lowering your taxable business income. I'm going to say that again. The interest paid on loans for your business can be deducted as a business expense, lowering your taxable business income. I'm saying these things very slowly because in a moment we're gonna speed it up on you, and I'm hopeful that you can remember what we've talked about thus far. Tax deductions knowing which types of loans and which interests are tax deductible can help you optimize your tax strategy, and overall, it can help you reduce your overall borrowing cost. Loan types, if you understand the loan types that are available to you, different loans serve different purposes. And they come with a varying interest rate, right? They come with different tax implications. So by understanding the intricacies, you can make more informed decisions about how borrowing money and managing your finances can impact your life. You know, if you have specific questions, you want further details of what we're talking about, feel free to ask. Your community is on the outside waiting for you to crawl out of the dark, ask for help, turn the lights on. And you can do that just by simply just joining our lifestyle focused community and start asking. And one of our teammates will reach out and help you at any time, right? Or better yet, schedule some time to sit down and talk with me about it. Schedule a one-on-one. And I'm sure I can help you out. I'll do the best I can, right? So let's take a look at the comments. What do you guys got in the comments today? Everybody's just saying hello, hello, hello. Okay. All right. Hello, everybody. Hello, everybody. I understand. Well, let's take a look at the what wealthy people don't share with you very often. I want to share with you where wealthy people start to look more and more at loans. So here are 3 types of loans that are lower than unsecured loans. And I'm going to share with you what they are. So here you go to write them down. Cash value, HELOCs, and margin accounts. Cash value, home equity line of credit, and margin accounts. And we're going to talk about how the loan interest works on these things, the types of loans that are available. And once again, we're going to talk about the impact it has on your income tax. And we're going to provide you some examples, just like we just did before. Is this good stuff or what? Is this good stuff or what? We want to provide you with the information that that no one out there is willing to talk to you about, right? Well, number one, cash value comes from this thing called life insurance. And how it works is this. Cash value are loans that are taken against your life insurance policy. And the cash value accumulates over time as you pay premiums. You can borrow against this amount without needing to qualify for a traditional loan. The interest on a cash value loan is typically lower than unsecured loans. However, if the loan is not repaid, the outstanding amount plus interest is deducted from the death benefit. The tax impact of that is simply this. The interest paid on cash value loans is generally not tax deductible. However, the loan itself is not considered taxable income unless the policy lapses or is in surrender. So what I'm saying to you is you probably want to keep your policies in force. For example, if you have a life insurance policy with cash value of $50,000, let's just say, and you might be able to borrow up to 90% of that amount. The interest rate on this money is 5%. You can borrow $10,000. You would only have to owe $500 in interest annually after the end of 12 months. That's not a bad deal. And don't forget the fact that on the $10,000 that you borrowed, because you're borrowing against the insurance company's reserves, your cash is still growing compounded interest. That's the secret. Wait a minute. Because I didn't necessarily take my money continues to grow. Yes, that's what I'm saying. Never mind those other guys on those TV shows giving all that lip service as if they're experts. Telling the world why they don't want these products. Well, share with me why the wealthy want these products, right? Two different points of views. The wealthy is looking at the leverage of the policy, and people who make a little less money, they're looking at the premium of the policy. This is the difference. This is the difference in the scope of understanding these loans, right? Number two, let's talk about the home equity line of credit. This is how it works now. The home equity line of credit, or the HELOC. It's a revolving line of credit secured by the equity in your home. So typically it has a variable interest rate in a drawdown period of usually about 10 years. So during this 10-year period of time, you can borrow as you need, followed by a repayment period. So basically, you're able to use this equity line of credit for whatever reason you want. Okay? It's sitting there in your house. Now, don't go too far ahead of me, because I know some of you are already thinking, if I get my hands on my equity, I can go ahead and spend it. Just like you did with the $2,000 on your vacation just a moment ago. We might not want to spend it the way you're thinking about it. We want to look at it how wealthy people are looking at it. What would wealthy people do? I think if we stop and start to ask ourselves, what would wealthy people do with this opportunity? Anytime we get cash, we'll have a moment to start doing things a little differently, wouldn't you say? Well, here's how the interest works on that. Interest rates on HELOCs are generally lower than unsecured loans because they're secured by your home. Cash value loans are secured by your death benefit of insurance. HELOCs are secured by your home. Okay? So you only need to pay the interest on the amount that you borrow. The tax impact on this money is that the interest on a HELOC can be tax deductible if the loan is used to buy, to build, or substantially improve your property. That secures the loan. So in other words, if you're building let me give you a better example than what I was just about to say. Here's another example. If your home is worth $300,000 and you owe $200,000 on your mortgage, you have $100,000 of equity in your home. You might even be able to get this HELOC for up to 80% of your loan value. So if you borrow $20,000 at an interest rate of 4%, you would only owe $800 in interest annually. But if I used it as a renovation project, where I put new bathrooms, new kitchens, heck, I may even build a new floor on an old existing property. I've just increased the value of that property. And if I do that, that's where the interest on that HELOC can be tax deductible. Did you get that? I'm telling you, the financial literacy here is key. The financial literacy here is key. Thank you, Ms. Henderson. I appreciate that. Sam, I appreciate that. Because I know there's people watching, and I know there's other people watching. I wish you would engage. Do me a favor. Help our channel out. Help our channel out. Go ahead and hit that. Hit the thumbs up button. Hit the subscribe button. And help us out. Because we know we're watching. I know 72% of the people watching us are not members. And ladies, we need to get some of you ladies clicking the button. So lady friends, share the button. My brothers out there all over the world, thank you guys for joining in. But we need to balance the attack, right? We need to balance the attack. We want our ladies out there to be as financially savvy as you guys that are joining, right? We want a community that's balanced. Would you agree with me on that? We can all use that literacy, right? We can all use that literacy. Here's the third one I want to talk to you about. Margin accounts. Margin accounts. So number one was cash value loans. Number two was a HELOC loan, or better yet, line of credit. And number three, margin accounts. So listen close. This is how it works. A margin account allows you to borrow money from your brokerage firm using your investment portfolio as collateral. Am I making sense to you guys now? Sometimes these fancy words such as the margin and the cash value and the equity, for those of lower income or probably lower exposure, they're still loans. First, understand the very basic principle that they're just loans that you can use to leverage, meaning to your advantage. Okay? So don't let all the wordplay discourage you. They're just loans. Okay? But they're backed by something. That's what makes them an asset. They're an asset because they're backed by either cash value, they're backed by the property that you live in or that you own, or they're backed by the investment portfolio as collateral. This type of loan is often used to purchase additional securities. The interest on this type of loan, on a margin loan, it varies, but it's typically lower than an unsecured loan. However, if the value of your investment were to fall, you may face a margin call. What they're saying, a margin call is nothing more than them saying, hey, we're requiring you to deposit more funds, or you need to sell some of your assets to cover the deficit, to cover this loan that we have outstanding. In other words, if you were to lose $1,000 in the market that day and they were to have a margin call, they're going to request that you put in another $1,000 so that you're over this the margin limits. But here's the tax impact to a margin account. Interest on margin loans can be tax deductible if the borrowed funds are used for investment purposes. The deduction is limited to your net investment income. Let me explain how to give you an example. If you have $50,000 in your brokerage account, you might be able to borrow up to, say, $25,000 on margin or in a loan. If the interest rate is 6%, you would have owed $1,500 in interest annually over 12 months. So if you use this loan to buy more stocks, the interest may be deductible against your investment income. Does that make sense? Wait a minute. Are we drawing the lines now? You know, financial education, financial literacy, and financial intelligence. For me, financial intelligence is when we start taking all these key elements and we're putting them together so that we understand how they work and stop trying to pit them against each other. You know, you get these advisors out here that, oh, you can only put your money in the stock market, or, oh, you only need to have your money under management, or better yet, I don't need any of it. I got a whole bunch of cash because I'm buying real estate. Or the insurance person that's saying, no, you're going to die tomorrow and you need more insurance. No, that's not how this works. That is not how this works. If you can see the thread here, when you have an asset such as insurance, permanent insurance is what I'm talking about. When you have an asset such as, or securities, such as a real estate equity, or you have an investment portfolio that you can use as collateral, as these things grow in value, it can and may be deductible in interest. Okay? That's on the securities. The cash value, not that way. Only because it's not seen as taxable income at all anyway, okay? So here's some of the key takeaways. So the key takeaways on interest rates: secure loans on HELOCs and margin loans, they generally have lower interest rates compared to unsecured loans. So I know that there's people that when we're talking about business finances, we talk about unsecured lines of credit all the time. But they may have a little bit more interest because the fact is they're not secured by anything, right? But simply owning a HELOC or having a margin account, those loans are generally lower, and in my opinion, easier to get. The tax deductions and the tax deductibility of the loan interest, it varies. HELOCs have interest that can be deductible only if used for the home improvement, okay? While margin loan interest can be deductible if used for more investments. If you're buying more investments, then you can see the deductibility. But here's the risk. The risk that you see and the risk that you take are that the loans are secured by an asset, your home or your investments. So carrying this risk of losing those assets if you cannot repay these loans. You're carrying that risk of losing these assets, okay? If you can't pay it back. But I think that's why it's important for you to understand how these things work and the intricacies of how they are working and how they can help you make a better, stronger financial decision about borrowing and managing your finances. So if you have any extra questions on that, hey, look me up. Go to Ronco Johnson, roncojohnson.com, or just reach out and to our Lifestyle Focused Wealth team and schedule some one-on-one time, and maybe we can walk you through this process. If this information is good to you, it has been good to you today, let us know. Be proud about it. Click the button, give us a thumbs up, put in the comments, takeaways. Let me know if I've said something thus far that you didn't know about, that now you feel that you can take from this broadcast and go right into the world and share it with your friends, family, and start building your legacy. I see you guys out there. I do. I see a couple questions coming in. I'll tell you what we're going to do. I'm going to tell you why it's important for you to be a part of our membership. Hey, join our Lifestyle Focused Wealth community. Membership starting at $16 a month when you pay the annual subscription. So register online today at www.lifestylefocusedwealth.com. Hey, it's Ronco Johnson, your Lifestyle Focused Wealth coach. How are you guys doing today? Thank you. We've had a pretty good conversation about how interest and these loans out here work, right? We've had a pretty good situation today. So we're talking about how these loans work, and 3 of these loans that are available that are less expensive than unsecured lines of credit. It's crazy. We get calls during the middle of the show. I should learn to turn my calls completely off. But we're human. We're real people. This is live. We forget sometimes. We do forget sometimes. Okay? But we want to make sure that you got the detail that you need. We want to make sure you got the detail that you need. So what do we have out there in the questions? Let me see what we got. A beautiful thing. People need to know this information. Thank you, Ms. Henderson. Using another financial tool is so important. It's so important because you may not even have to go in and qualify with an income statement or your credit scores or any of this. We're talking about empowering you. That's what Lifestyle Focused Wealth means to me. And that's what Lifestyle Focused Wealth, the community, is more of a holistic way of looking at your finances. Okay? And what we're looking at here is how, instead of doing one thing at a time, I call it networking and net weaving, right? We want to make sure that this information is tied together. Because realistically, just like in real life, guys, we're all tied together. Our energies, our spirit, it's all tied together. If you don't believe me, have you ever been in a room with someone who's not having their best day? And they're a little funky? The minute they leave the room, you notice that your attitude has changed, has shifted. You're a little funky. Maybe you walked in the room and you had a lot of positive energy and they were just a little funky. what happens? Their vibration comes up. Your vibration comes down. Why? Because we're exchanging energy. We're exchanging energy. But what happens if you got a room full of positive people exchanging high value information? It can only go higher. It can only go higher. And when we're with other people who are engaging in high level thinking, high level production, high level conversations on a day-to-day basis, you start levitating in business. Your mind starts levitating. Your business starts to take off. There was a conversation we were having the other day about a wealthy guy who went into a bank. He's in New York City. He went into a bank and he asked for a loan. And he drove up in his brand new luxury vehicle and said, "You can keep my car for collateral." So the guy left his brand new Lamborghini at the bank for $5,000 of a loan. A week later, the guy comes back. And the banker said, "Why would you leave me your $500,000 car for a $5,000 loan?" The wealthy guy said, "The interest on that loan only cost me $50. Where can I park my car for $50 in New York City?" It's how we process things. You know what I know? You probably take more than that in your car. Garage at the airport. Sometimes when people move different, they just move different because you don't understand the movement. That's the difference between wealthy people and the not so wealthy. This is the truth. The knowledge that that man had to go take his car to the bank and take a loan and give his car as collateral where they're going to store it, take care of it for $50 while he's out of town. He can go for a month and he still only pays $50. Just a different way of thinking. Whereas the poor are still thinking about taking this loan and they're going to go buy a big screen TV or they're going to go get in debt, where the wealthy are looking at these things and saying, "I'd rather pay the tax. I'd rather pay the interest on this money to start a business than pay the tax on the income maintaining my lifestyle." I just want you guys to know that's just the difference of how we think, right? It's just the difference of how we think. So if this is making sense to you, thank you so much for joining us. We want to make sure that everybody's out here has the opportunity to level up, right? Schedule some time with your Lifestyle Focused Wealth team today. Go to lifestylefocusedwealth.com and see if you can schedule some time with us. I'd love to sit down and talk to you even more. And let us know that this content is hitting you in the right place and that you see value in what we're talking about. This is our form of financial education. And we're loving the impact that we're making on you and your lifestyle. Thank you so much for watching us. So if you want to continue looking at the full versions or learn a lot more of these financial tips and much, much more, please hit the notification bell below. All right? Hit the notification bell below. And I can't wait till I see you next week. I can't wait till I see you next week. And here's the reason why. Because I know we have more information on how we're going to take these topics that we talked about today and how we're going to be a little bit more creative about how we're going to use them. We're going to give it to you in pieces. We're going to give it to you in pieces. That way you can use it, explain it, take a week, digest what we're saying, comment on it, send me information below, and then go out here and we're going to rock it. We're going to rock it. We're going to start using these lines of credit. We're going to start using these margin accounts. We're going to start buying up equity. We're going to start buying up cars. We're going to start buying up businesses. And the cars, by the way, we know that cars are a bad investment only if no one else is driving. So we want to start thinking outside the box. What will wealthy people do? That's what I want you to remember. Hey, thank you so much for this week. I'm your host, Ronco Johnson. Thank you so much. This has been When the Lights Go Out. Are you ready? It's Lifestyle Focus Friday. I wish you well. I wish you peace. I wish you joy. And I wish that you have a happy holiday weekend. And I look forward to seeing you next time at the top. God bless you. And I'll see you next week right here at 1 o'clock every Friday. This is When the Lights Go Out. Are you ready? Peace out, everybody.